Mortgage rates improved yet again, starting the day off with 30-year fix sitting at 6.29%. Yes, you heard that right, 6.29%, the best levels we've seen in over a year. This is all on the back of jobs report last week being a huge miss, new jobs data this week adding to that miss, coupled with both wholesale and consumer inflation coming right in line with expectations and below in some instances. All of this setting the stage for the Fed to finally start cutting at their meeting next week. So what does this mean for affordability, and how can we be using this to empower our clients to make informed decisions? That's what I want to cover on this week. So as I mentioned, last week was the driver of this recent rally with jobs missing by a large margin. Bureau of Labor and Statistics jobs report for August. This week we received biannual revisions extracting close to 1 million jobs from March of 24 through March of 25, aiding in that base case that the labor market is weaker than previously perceived. As we remember, Jerome Powell said at Jackson Hole, the labor market is now our primary focus. Yes, inflation is important, but labor maximum employment remains their primary focus. And with jobs report last week, jobs revisions this week, and a rise in continuing claims, individuals filing for unemployment for the first time, traders are convinced, Wall Street's convinced that rate cuts are now imminent next week. Layering in, we received additional inflation data both on the wholesale side and consumer side, showing inflation on the wholesale side actually declining both on a year-over-year basis and month-over-month basis, coupled with consumers coming right in line with expectation. The inflation case is really being flipped on its head. And that inflation, yes, it is still of concern, but it's not as runaway as it was previously perceived. So with that, it continues to build the narrative that, yes, the Fed will cut next week. And if we look to Fed Watch tool, which has been one of the most accurate predicting tools through this entire cycle, there's a 94% probability that the Fed will cut at least 25 basis points. Now, we know that to be true in how the market has responded with this recent run in rates. So how can we be using the data of today, where I know most of our clients are coming back saying, hey, we're waiting for the Fed to cut rates next week? Well, as we saw in the last cutting cycle last year, when the Fed cut, rates went higher. So the market is already expecting a 0.25% cut in rates. If the Fed only does that, there is a strong case to be made that we'll see stability or potentially even worsening in mortgage price, because that market's already expecting that. It's already baked into the price. So depending upon what his comments are next week, we could see some incremental volatility with how mortgage rates respond. So yet, if we see a larger cut, we could see prices run away for the better. So the script we need to be communicating to our clients is affordability is here now. The 0.5% we've seen improvement in mortgage rates over the last 30 days correlates on a $500,000 mortgage to about $250 a month, which is meaningful dollars in our consumer pockets. Take advantage of the narrative now. Yes, we've seen an increase in inventory, decrease in mortgage rates. Let's beat the rush and take advantage of the market we have here now. If you're running into challenges with communicating this message, please reach out. My team and I would love the opportunity to help. If you find value in what we communicate here, please subscribe to the channel. Forward to somebody you think that could use this information as well. As always, let's make it a great day and an even greater weekend.